Most traders use indicators, RSI, MACD, moving averages, but still lose money. Why? Because they don't understand one simple thing: where price actually moves from. The market doesn't move randomly. It moves from supply and demand zones. In this video, I'll show you exactly how supply and demand works, how to find these zones, and how to trade them like a pro. Part 1. What is supply and demand? Let's start with the foundation. Supply and demand is one of the most important concepts in trading, but also one of the most misunderstood. At its core, the market moves because of imbalance. When there are more buyers than sellers, price goes up. When there are more sellers than buyers, price goes down. That's it. Now here's where it becomes powerful. Supply and demand zones are not random areas. They are specific price levels where big institutions place large orders. These are the areas where the market made strong moves. So when price returns to these levels, it often reacts again, because those big players are still active there. So instead of chasing price, you start focusing on where price is likely to react. That's the mindset shift. Part 2. Why supply and demand works. Now let's understand why this works so well. Big institutions don't trade like retail traders. They don't just click buy or sell once. They build positions over time. And because they trade huge volume, they need liquidity. So what happens? They create zones where they can enter and exit. When price leaves a zone with strong momentum, it tells you something important. There were large orders sitting there. But here's the key: not all those orders get filled instantly. So when price comes back to that zone later, those remaining orders get filled. That's why price reacts again. This is not guesswork. This is how the market actually operates. Part 3. How to identify zones. Now let's talk about how to actually find these zones. This is where most beginners get confused. Step 1. Look for strong moves in the market. Big candles, fast movement, clear direction. That's your signal that something important happened. Step 2. Go back to where the move started. This is your zone. If price moved up strongly, that's a demand zone. If price drops strongly, that's a supply zone. Step 3. Mark the base of that move. Usually a small consolidation before the big move. That's where institutions were active. Now here are some important details. Zones with sharp moves are stronger. Fresh zones are more reliable. Zones tested multiple times become weaker. And most importantly, keep your zones clean. Don't mark every small movement. Focus only on strong, clear zones. Part 4. How to trade supply and demand. Now let's turn this into a real strategy. Step 1. Identify a strong supply or demand zone. Take your time here. Don't rush. Step 2. Wait for price to return to that zone. This is where patience comes in. Most traders fail because they don't wait. They chase price instead. Step 3. Don't enter immediately when price touches the zone. This is very important. Wait for confirmation. Look for signs like rejection wicks, strong candles, change in momentum. Step 4. Enter in the direction of the zone. Demand zone, buy supply zone, sell. This way, you are not guessing. You are reacting to what the market is showing. Part 5. Entry, stop loss and target. Now let's make this practical. Entry. Enter after confirmation inside the zone. Don't enter blindly. Let the market show its intention first. Stop loss. Place your stop loss just outside the zone. Below demand zone for buys. Above supply zone for sells. Give it a little space. Markets are not perfect. Take profit. You can target previous highs or lows. Opposite supply demand zone are key structure levels. Now here's an important rule. Always think in terms of risk. Vs reward. Don't take trades where the risk is bigger than the reward. Aim for at least 1-to-2 ratio. This is what builds consistency. Part 6. Common mistakes. Now let's talk about mistakes, because avoiding mistakes is just as important as learning strategy. Mistake 1. Entering too early. Many traders enter as soon as price touches the zone, without confirmation. This leads to losses. Mistake 2. Drawing too many zones. If everything is a zone, then nothing is a zone. Keep it simple. Mistake 3. Trading weak zones. If a zone has been tested multiple times, it loses strength. Mistake 4. Ignoring market structure. Always consider the overall trend. Don't blindly buy or sell. Mistake 5. Being impatient. The best trades come from waiting, not forcing. Professionals wait for the right setup. Beginners chase everything.